So today we have the Wilson Asset Management team. We've got Sam Koch, Anna Milne, William Liu, and Denny Hoxha. Welcome, guys. Thank you for joining us. They're all equity analysts at Wilson's Asset Management, and they specialize in different areas of the market. With so much information out there and so much noise for us to shift through, the team will be giving us some practical tips on how to turn the blinkers on to avoid information overload. Now, standard disclaimer, all information presented today is for education and entertainment purposes. Any advice is general in nature and has not taken into account your personal circumstances, needs or objectives. Now, before acting on any general advice, you should consider whether it's appropriate to you and meets your financial needs. If you are unsure, please speak to a financial professional. However, really exciting, Equity Mates now has their own AFSL. So the license number is 5006797. But please, everyone, welcome the team.
Thanks everyone for joining our session today. My name is Anna Milne. I'm an equity analyst at Wilson Asset Management. I'm joined here by my colleagues Sam Koch, William Liu and Denny Hoxha, who are representing their respective funds. Let's get straight into it. This session is called the information game because that's exactly what markets are. They are an information game. You either have the best information or you have it first. And if you don't have it first, at least have it before the rest of everyone else knows, the masses know, and that is how you really generate alpha in this environment. So we live in an information age, and there are good aspects of that and there are bad. It's fantastic that everyone gets the exact same information at the same time. For example, if you like the stock WiseTech and you set up an alert on your phone on the ASX app, you'll know as soon as I do at the exact same time when they release something to the market. And that is a benefit that previous generations before you have not had. So I think that's really exciting and it's fantastic that it is leveling the playing field. On the flip side, there is more information than we could possibly consume in our lifetimes, even when we're looking at a small part of the market. And so it can be overwhelming. What sources do you trust and how do you know what matters? That's what we're going to try and break down today. So we are professional investors, so we speak to thousands of companies a year. We are talking about companies all day, every day, but our job doesn't stop at 5 p.m. Every single thing we experience, every single thing we hear, everything we read, everything we see has some value when it comes to investing. There are unlimited opportunities to make money as long as you have your blinkers on to what's around you. An example that I personally had from what I experienced outside of work was I booked flights home to New Zealand and they were eye-wateringly expensive. And then 2 days ago, Qantas released an announcement to the market and they said that their earnings are going to be double what the market was expecting because they have really jacked up prices. They're the only player in the market and everyone is wanting to travel. So that's an example of something that I'm sure you are all aware of, but you can actually use that to make you money. So with that, I'm going to pass on to Sam Koch, who's a senior equity analyst in our small and mid-cap funds. Sam, take it away.
Thanks, Anna. My name is Sam and I work as a senior equity analyst at Wilson Asset Management. I work across 4 of the 8 products that we have. That's WAM Capital, WAM Research, WAM Active and WAM Microcap. And Wilson Asset Management has 8 listed investment companies and these are commonly known as LICs. And effectively what we're doing there is managing up to $5 billion on behalf of 130,000 retail shareholders. Now, LICs is it can be a confusing word. Some of us might have come across it, some of it might not have come across it. So what a listed investment company is effectively a fund that offers investors access to a portfolio of companies, be it Australia, internationally, or in the alternative space. But it's a pooled, stable, it's a stable pool of capital. So that means that people can't necessarily take their money out and they can't put new money in. That means if you want to become an investor, you have to buy shares of an existing investor in the market. So all of our companies are listed on the share market. WAM Capital, the largest one of those, is under ticker WAM. Now, why a LIC structure? From our perspective, it actually gives us the benefit to be able to adhere to our rigorous investment process and invest throughout the market cycle. As we've seen, the market is a cycle. It can go up and it can go down. And as long as our investors, aren't getting scared and taking money away from us, that means that we can invest and really for the long-term benefit of their returns. Now, long-term benefit of their returns, and that's something that we're really excited about at Wilson Asset Management. There's one thing that Jeff has always said, it's you actually want to be investing or you want to put your money to work when there's blood on the streets. It's quite a dark saying, but at the same time, you want to make sure that you're investing against the grain of the crowd. So with that, I'll hand back to Anna.
To me?
I'll hand to Will, actually.
Yeah. My name's William Liu. I work at Wilson Asset Management in the global equity fund. So I'm looking at international stocks in Asia, Europe, the US, and our fund is under the ticker WGB. So when speaking about today, I was thinking, what should I really talk about? It's a bit of a weird environment. Everyone's got their silent headphones on. I feel like I'm kind of speaking to myself, so it is a little bit unusual, so I'll have to adapt, but we'll make do. So one thing about the information game is how you get your information. So as Anna said, information has now been democratized. There's YouTube videos, there's financial influencers, there's TikTokers, there's so much information out there. How do you synthesize that? How do you analyze that? And what actually is actionable and something that you can use to generate alpha and get returns that are above the market? So we do that WAM in a number of different ways, and it might be good to share a more recent experience. So as Anna said, we meet over 1,000 of companies every year. I was actually recently just in Europe. I was there for 3 weeks in London, Paris, and Zurich. And I probably met over 50 companies in the space of that time. So I was literally in a car, rented, driving around. I got stuck behind some cows and horses in Zurich, trying to go to a company to meet their management team, look them in the eye, see what's happening, what is the current state of the world, and get a sense, given, especially in this environment, everything is so volatile. You don't know what companies are doing, and even the companies themselves, it's changing week by week. So I thought it might be insightful to share with you a few of the insights from that trip. So firstly, demand, it's probably holding up a little bit better, even though it's weakening, it's holding up a little bit better than expected. So even just going to restaurants, stores in London, Paris, Zurich, there's lines outside of LVMH. The restaurants were packed, everyone had a drink in their hand. It wouldn't be, we read the headlines and we sort of go, okay, a recession is imminent, consumer demand will weaken, interest rates are higher. But it's probably not happening at the pace that what you expect, and LVMH just reported a record result a couple of days ago, so that gives you a little bit of a sign that maybe demand is holding up a little bit better than expected. The concern in Europe is going into winter, so what happens is energy prices is super topical, so every company we talk to, we're asking them, what is energy as a % of your sales? How much is that going up? And the consensus is that's going up 3 to 4 times versus last year. So there's no way that doesn't have a margin impact to a business. So as we go into the winter, it's going to be more telling in terms of how consumers behave, how industrial companies perform, what is going to be the energy impact, and what's the margin impact from that. So margins, which leads on to margins, which is a key concern, because the other big takeaway was it's really hard to get labor and it's really expensive to get labor, and I'm sure we see that here as well. So wage inflation for most companies was probably running at 3 to 4% a year. A lot of companies are budgeting for that to almost double, 5 to 6%, and it really depends on where you're working, which industries, how hard, and where the shortage of skill sets are. So that's probably another key takeaway. And then finally is management are preparing for the worst. So they're trying to right-size their cost base. They acknowledge, even though they might not see the deterioration right now, they do acknowledge that there is probably a likelihood that Europe probably goes into a recession. The US is still uncertain where they land. Asia Pacific is a little bit of a basket case, because if you can tell me what's going to happen with China, please speak to me after this session, and I'd love to hear your thoughts. So, which leads us back to the investment process. So I've always been taught that there's 3 ways to get an edge in markets. Firstly, information, have more information, be first to act on that information. Second is to analyze that information in a better way. And then finally is to be contrarian. And we try to incorporate that process in our investment process at WAM. And I think the best way to illustrate that could be going through a stock example. So we invest in small mid companies. One of the companies we invested in was called CVS Group, small cap, listed in the UK. What they do, they're a UK vet services provider, so they do veterinary practices in the UK. So we think it's a really attractive sector. Vet services grows at 6 to 8% as an industry per annum. We think CVS Group can do better than that. They can also do acquisitions to consolidate the sector. And we think it's quite an interesting space, particularly in this moment of time where people are looking for resiliency and people are looking for comfort in the earnings profile because 2023 will be quite uncertain. So we think there's a longer term trend towards humanization of pets. It's clearly evident, like I'm sure many people here know someone or probably adopted a pet in the last couple of years. They're all over social media. They're sleeping in the house, they're sleeping in your bed, they're probably eating better than you do. So there's clearly this trend towards humanization of pets, increasing adoption of pets. And it goes into the whole thematic of people seeking companionship, people getting married later, pets are shown to help with mental health problems, etc. So we think it's a really longer term sustainable trend. The thing that's interesting is that vets spend on a pet, for every year a pet ages, the vet spend actually goes up. So it's not a short-term bump in the pandemic where you saw adoption of pets, those revenues are going to go away the next year. We think it's a sustainable trend. So our analysis shows that vet spend increases per year of a pet's life cycle. The other thing is that the analytical work is, when we invested in the stock, RSPCA ran out of pets to adopt during the pandemic. The breeders' prices were going up multiple fold. So we were getting conviction that this is a good space to be. So if I look at the business, where we're being contrarian is, I guess, we think the margin profile is sustainable and we think the valuation is trading less than M&A multiples. So if you look at the business, it's trading on less than what private transaction multiples are taking part at. It doesn't have a lot of leverage on its balance sheet. Its free cash flow conversion is still very strong. We think it's like a good example of a stock where we have an information edge. We've met the management team. We chat to them on a quarterly basis. We went to visit them in the UK. We sort of know what's happening and we're staying very close to the company, so we can get that conviction and we can get that comfort that the earnings aren't going to disappoint. The valuation will move around based on interest rates, macro, what have you, but we do have conviction that the earnings profile is resilient and that we can be comfortable investing despite this turbulent time in the market where there's a lot of noise going around. So I know I've spoken a lot, but it's a little bit of an example about how we get an information edge. We are very close to the information, whether we're in a privileged position to get access to management or whether we have the ability to go overseas and actually see these vet practices in person. But it sort of gives you a very short insight in terms of how we do our work, how we do our due diligence in our investment process. So with that, I might pass to Denny.
Yeah, thanks, Will. So my name's Denny and I work at Wilson Asset Management in the Alternatives Fund. So I think I'll start just by defining alternatives. It's a pretty fluid term, to be honest. Like, it can be defined different ways, but within the context of our fund, we typically talk about investing in unlisted assets. So we hold anything from private equity, venture capital, to infrastructure, real estate, and we even hold real assets, so like agricultural land or even some more esoteric assets like water rights. The information game within alternatives is a bit different to like the public realm, but the fundamental underlying principles of investing is the same. It's all about getting an information edge. There is complexity and difficulty in accessing information in alternatives. There's no centralized exchange where you can go and look at the price every second to get an idea. There's no, the information isn't reported as regularly as regulatory requirements require, public companies to do. So that creates challenges, but it also creates opportunities, and it creates more opportunities to get that information edge, that arbitrage that can let you potentially generate outsized returns. In saying that, it's vital that you conduct your investment due diligence, and within alternatives, the way we kind of handle that and the way we approach our investment research is we invest for the long term. So in alternatives, because they're unlisted, they're illiquid assets. So you could be holding these assets anywhere from 5 to 10 years and not be able to trade out of them. So when you go into an asset, you really have to be sure and have full conviction on the investment thesis. So I guess in terms of that, we follow 4 main megatrends. And these are like long-term structural trends that will support the investment thesis and that are sure to support it throughout that entire long-term investment horizon. So the 4 megatrends we follow is climate change, growing demand for food, digitalization, and aging population globally. So again, if you invest on the basis of these megatrends and essentially, because there's not much publicly available information, having your feet on the ground, meeting with management teams, meeting with fund managers who you might be partnering alongside with on these investments is vitally crucial to get the information. But it's kind of paradoxical because once you decide to do your due diligence on an investment, in some ways you can get even greater access than would otherwise be available in public markets. So for example, I'll go to senior secured debt as an example. This is like debt lending to highly cash flow generative mature companies, and essentially when you're structuring this instrument, you get unhindered access to the financial records of a company, you get unhindered access to management, so you can really structure that debt instrument for downside protection, et cetera, et cetera. But yeah, I guess some opportunities that we're seeing that will be areas to watch going forward would be within private equity turnaround and transformation. So this particular strategy, you would invest in distressed companies, so they're fundamentally sound companies. However, they've, for some event-specific reason, they've come into some distress. And this gives you the opportunity, if you know the complexity and if you're partnering with very adept management teams who have a lot of experience in this area, to enter in at attractive valuations, implement a turnaround strategy, so there's active management alongside just investing in the company, and position it for growth. And you can exit that and potentially get some outsized returns. So as we continue with these macroeconomic stresses, we hope to see more and more opportunities arising in that sense. But yeah, that's all from me, so I'll pass back to Anna.
Thanks, Denny. So again, I'm Anna, so I'm in the large cap fund at Wilson Asset Management. So we look at the largest companies in Australia. Our universe is the ASX 200. So that is the likes of the big 4 banks, BHP, Rio, Telstra, Woolworths, Endeavour, who owns Dan Murphy's, Wesfarmers, who owns Bunnings, all those names that you already all know. And that's exactly why it can be quite difficult to have an edge in this market, because it's so widely followed. There are analysts that dedicate their entire time to looking at this small handful of companies that we can't really get an edge that way. So the way that we get our edge, and there is empirical evidence that backs this up, is greater than 50% of all share price moves in the large cap land are driven by the macroeconomic environment. So by macro, I mean fixed income markets, I mean commodities, I mean foreign exchange. So that's what we spend all our time doing, looking at every single other market, aside from the equity market, that gives us clues as to sentiment, as to flows, and basically where the world is going, what's going to be in favour and what's going to be out of favour. And often the equity market lags all of these other markets. They provide really good signals for us. So when you think about the ASX 200, 20% of it is the big 4 banks, being CommBank, ANZ, Westpac, and gosh, what one have I missed? NAB. And then 40% of the market is resources. So that is BHP, Rio, Fortescue, they're the big 3 iron ore miners. You have the new fun lithium names. You have the oil and gas names like Woodside and Santos. Woodside has recently become a top 10 global oil and gas company. So these are really big names actually on the world stage, and even more so for us. And these names are really driven by commodity pricing. So that's one reason why we really follow commodities. So our information edge is by following all of these different markets, and that might be a little bit difficult as a retail investor, but that also, we have a different approach in that we're not really buy and hold, we're extremely active, so we are more than willing, if the information changes, we'll completely flip our portfolio. And that sounds easy, but when you're running around 1.5 billion, it's a bit of manoeuvring that's required. And we turn over our portfolio about every quarter. So we're extremely active. That is our process, very top down. We then decide what sectors we want to invest in based on the exposures that we want based on the macro factors, and then we choose our stocks in between there. We do have a quality bias. I think quality always wins, regardless of whether you're in a bear market or a bull market, you can always rely on quality. So I think that's maybe one of my main takeaways for you all today. And we also really rely on sentiment and flow indicators. So we're watching share prices. I think share prices are a really good indication of sentiment for a stock. So clearly if a share price is going south, people are selling. There are more sellers than there are buyers, and either there's something negative going on within the company or the macro moves are not very favourable. So you have to weigh up catching a falling knife versus getting a bargain. But I mean, if everyone knew that, we wouldn't be working at WAM, we'd be running our own funds. So I would say that is our process from an information perspective. When it comes to where we get our information, I think there is no better place than the horse's mouth, as we said. We have the benefit of being able to meet with management teams ourselves. But for you all, it's AGM season at the moment, so every single company is presenting. You can find their webcasts online. You can listen to the chairman speak or chairperson speak. You can listen to the CEO, CFO speak, and then after results, there's often question and answer sessions with brokers, and I think these are really, really valuable tools for you all because these analysts follow these stocks to the nth degree. They are asking the most important questions about the stocks, and that's exactly what you need to be across as an investor. So you can find them on their website. I would basically stick to facts. I think there is so much noise. You can spend all day reading the SMH or the Age or the Australian or whatever your form of media is, Twitter, TikTok. Spoken like a true non-Gen Z when I have to remember what it's called. But I would stick to the facts, really focus on the company's financials, the management themselves, and I think there's a big opportunity for you all. I think all institutional shareholders, institutional investors have become quite short-term because it's so volatile and you just can't really over the short term make money with a long-term mindset. But you all have the benefit of being long-term investors. You buy and you hold, and there are so many opportunities at the moment with that in mind. Things that, because everyone's really concerned about impending recessions and consumer confidence and CPI, which is inflation, a lot of stocks have been really, really hurt, and they're great companies. And I think for you all, if you have more than a 1-year view, if you want to hold for 5 years, you want to put it in the bottom drawer and forget about it, there are a lot of names. We've started in our portfolio, moving our portfolio to some of these really beaten up names, such as the companies that are exposed to the building cycle. So building materials companies like James Hardie, Reliance Worldwide, those tickers are JHX and RWC. And we also really like REITs, so they're real estate investment trusts, the real estate companies like Dexus, who own a lot of office buildings in Sydney and Melbourne and around the place. GPT, the ticker is GPT. Goodman Group, ticker GMG. These are all names that are high quality and have been really hurt because everyone has this short-term view on them. But if you're holding the medium term, I think they're safe places to be. They're good companies, they have good management, they have dividend yields. So that would be my kind of stock kind of ideas at the moment. Back to you, Koshi.
Yeah, thank you. I was keen to share, obviously, the process that was in the small to mid-cap domestic funds that I'm a part of. And obviously, like in that space, which was the original funds that Jeff sort of set up, that process hasn't changed over the last 25 years and stood the test of time through multiple cycles. What we're doing there is we're trying to find undervalued growth companies that have a catalyst to see that valuation change. Now that's a great tagline, I have to admit, but at the same time there is meaning behind those words. So we're focused on growth companies. As Anna alluded to, we're looking for quality names that are beaten up. We're looking for undervalued companies, so they have to have a margin of safety in their valuation relative to where they should be trading, whether it's relative to their historical valuation range or relative to another housing stock or relative to the market in general. We're looking for some margin of safety there. And lastly, the most important thing as part of our process in small to mid caps is looking for a catalyst. Now, the catalyst can be anything from an acquisition. It could be the business divesting of another business. It could be the fact that they're doing capital management. They're buying back stock in their own business. So you want to see the management team trying to change or trying to demonstrate the underlying value that's within the business that the market overall isn't seeing. I think that's really important. And it sort of filters into the next point because obviously information age, information game, it's very noisy in terms of outside of this space, but it's also very noisy in terms of the market as a whole. You often get very conflicting advice and conflicting signals. You know, a business might be performing okay, but the share price is underperforming. What do I do? Buy, hold, sell, right? At the same time, from my perspective, there's two key tricks that I use when I'm trying to filter out the noise. One, it's lean on the process, undervalued growth companies with a catalyst. But the second one is knowing that there's probably 3 to 4 things that really matter for the company. And beyond that, it's all extra noise, it's all extra fluff. I'll give you an example, and I'll go through a stock, a retailer. So for a retail company, all you're looking for stores, like-for-like sales growth, the margins.
What is that? Can you explain like-for-like sales?
Yeah, that's a great point. Like-for-like sales growth. So you want to see if the company's expanding the number of stores, you want to see that the sales growth is actually continuing to grow in each of those individual stores. So if I go from 1 store to 2 stores and my sales growth has gone up 100%, that's probably 0 growth on a same store sales basis. So you want to see growth from each one of those stores. Margins, so we're talking about operating margins and gross margins and operating margins. And lastly, inventory. So you don't want to get stuck with a whole lot of obsolete inventory when it comes to a retailer. That can really put a hole in your balance sheet. So those are probably 4 key things or 3 key things that matter for a retailer, and focusing in on those helps avoid the noise in the market. So I'll go through one example. We all love stock picks here. So my example is Temple & Webster, and maybe some of us in the room have actually bought products from Temple & Webster before. So obviously they're an online furniture retail company. We actually hold it within the funds, within 2 of our strategies, or 3 of the funds, and I also own it personally as well. Temple & Webster, effectively, what they've done really, really well is they've been able to start early, a lot earlier than some of their competitors, 10 years ago in fact, and they've built up a brand and a real breadth of product opportunity so that when customers are coming to them, they're getting a really positive experience. They're getting that repeat purchase. They're almost not having to compete as much on marketing dollars. And from our perspective, that's a real attractive quality relative to all of its other competitors in the market. And then secondly, focusing in on that undervalued aspect. You know, this business longer term should be generating sort of 15% EBITDA margins. It's currently generating sort of 4 margins at the moment. And as the business sort of scales towards that opportunity, the share price should follow. And then lastly, they have a rock solid balance sheet. I think it's capped at about 600 mil market cap. It's got $100 million on its balance sheet that they can do acquisitions or buybacks with. And we see a real opportunity for both of those things to occur in the future if we see further volatility in the market. So that's a stock that I'm really excited about. And we were keen to really demonstrate, I guess, the breadth of process and opportunity at Wilson Asset Management.
Thanks, Sam. So we have a couple of minutes left. So I thought, this is coming out of nowhere, but I thought a main issue I think that a lot of investors face is knowing when to sell. I think it's quite easy, well, not easy, but when you've got an idea, you've got no previous kind of emotion attached to it, you can buy it, but how do you know when to sell? Do you have any thoughts on the topic? Otherwise I can kick it off.
Yep. Yeah. Well, I'm happy to start. I guess sell is when, we talk about margin of safety and asymmetry. It's very easy, and it is, if you have a long enough time frame, it is okay, but when there's a lot of opportunities against each other, you do need sell discipline. So what it comes down to is earnings momentum. If earnings is going to go the other way, or if there's downgrades coming, we don't think you should be waiting for those to flow through for a company. The second is valuation discipline, and I think that's where many people went wrong coming out of the pandemic, where interest rates were really low. All these high growth stocks got bid up. People did extremely well without having to pay attention on valuation. But valuation is a function of interest rates, and you need to know when to pivot your thinking. So as inflation went up, the next level of thinking is, okay, interest rates will need to be a response to that, And the further response to that is valuations need to come down to more normal levels. And that's what we've seen in the markets right now, where your high growth names, the ones that are less backed by cash, less backed by earnings, they're the ones down 80%. And it's very hard to recover from a down 80% if you have especially if, even just emotionally, you've had a stock that you've done incredibly well out of, you're down 80%. Most people just get stuck. Okay, we're just going to hold. We're going to leave it and I'll look back at it. It could be a tax loss or it could be worth more in 5 years' time. So I think valuation discipline is something that I'd like to sort of emphasize, especially in this rising rate environment. It is a key factor for us in terms of sell discipline, and like if a stock is overvalued, it doesn't matter how good it is, you still need to pay the right price for it. So that's my...
Yeah, really quickly, if the management team's mis-executing or the management team's doing worse than your expectations, I think that's a key factor to add on to Will's list for sure. And you can see that in the results, so paying close attention to the results.
Thanks. I think lastly, I think it's even harder to sell when the share price has gone up and you're like, this is awesome, we've done really well, I'm going to keep riding it. And then you're like, oh God, has it reached its peak? Is this the best it's going to be? And I think maybe something to think about when that's occurring is to start trimming your position. So you don't necessarily have to exit it, you can start taking some of those profits. So you know, regardless, you've made some money. We often trim positions as they improve. On the downside, if it's really not gone your way, if your thesis was wrong or the information has changed, every day is a new day. Every single day, every single stock that we own is on notice to be sold. And I think it's so hard. Markets are hard. It's really hard to make money. It's really hard to get everything right. And we absolutely do not get everything right. As long as you're getting more right than you are wrong, you're doing well. And I applaud all of you for being here today and giving it a go. And I think it's really exciting that this next generation of investors is coming through. So thank you so much for your time, everyone. If you'd like to talk more to us, we'll be around. Otherwise, I'll hand it back.
Thank you so much, WAM team. That was absolutely fantastic.
Equity line.
I will say this about investing. Everything you do learn is cumulative. What I learned at 20 is useful.